hopefully finish up this chapter in this session. So we were speaking to agreed upon procedures, and we rounded off in that last session. And this time around, we'll be looking at the next unit on compilation engagements. Compilation engagements. So let's speak to this concept, and I hope it resonates with you very practically, because some of these concepts could be challenging to understand in the study text. So the idea around compilation engagement involves only preparing financial information, not auditing or reviewing it. Just prepare financial information. For example, a chartered accountant could be asked by a company to come and prepare their financial statements. That is a very simple scenario or an example of compilation engagement. So it's about assembling facts and not assessing assurance. So that's the idea about compilation engagements. So when you hear compilation engagement, think around compile, which means to collect and not to conclude or provide an opinion. Compile, just think about compiling or collecting information for compilation, not to conclude or to provide assurance. So the key features around this, using the case or CASE to remember what defines a compilation engagement. So the C is collection of data. The accountant gathers and organizes financial information. The A speaks to accounting expertise. The work relies on his accounting knowledge and not his auditing skills, but his preparation of financial statements, his accounting knowledge generally. S speaks to summarizing the information. Data is presented to the client or his recipients of the information in the form of the financial statements or schedules. And the E is there's no expression of assurance. So the accountant gives no opinion or assurance. Users rely on the information as it is, as he provides it. So when you think of compilation, use the case formula to be able to define compilation engagements and decipher it very comprehensively. So for example, preparing financial statements for a sole trader or a local club based on their records and receipts. So the practitioner or the chartered accountant compiles formats and presents, but does not verify what he did. He can't do the two because he can't be the maker and the checker at the same time. So compilation engagements involves compiling, collection, preparing. Very simple fact. So the output is the compilation report. Speaking to a short report may be issued, confirming that the practitioner prepared the financial statements from the information supplied by management or the client, and does not express any assurance or opinion on their accuracy. So take note that some compilations like TAT computations may not require a formal format. So an informal format based on the discretion of the practitioner and how the client wants it or how it would be comprehensive for the client could be provided based on that. So that's generally the idea around compilation engagements. And a quick recap speaks to compilation around preparation, not verification. It's about organizing data, not assessing truth. So in compilation, you compile. Very simple, you just compile, you don't confirm. You just use your expertise to compile, you don't confirm. So that's the nature of compilation engagements, and I hope these simple thoughts resonate with you. So for compilation engagements, you have ISRE, the International Standards on Related Services, ISRS 4410. For agreed upon procedures, 4400 guides it. But for ISRS 4410, for compilation engagements, ISRS 4410 guides the preparation of compilation engagements. So the core idea around these revised standards is that it governs compilation engagements where the accountant prepares financial information but does not provide assurance. So you need to think around preparing, not to prove the report. And the background of this revision came in March 2012 due to rising demands from small and medium scale enterprises needing help with financial reporting, but exempted from audit. So small and medium scale enterprises and small businesses are exempted from audits. But then to have their business structured around good reporting and structured reports, this standard came about and it was revised to help inject some of these needs for SMEs and small businesses. And the standard ensures that compilation work meets professional and ethical standards, even the IFRS. Even though opinion is not given, at least those prepared financial statements are guided by quality quality. And the key principles around the rule is, you could use this acronym to remember that the essence of ISRS 4410 is for due care in compilation and for competence around the practitioner providing it, and for compliance with IFRS internal and external rules. So that's what to remember, and that's the essence of the revision of ISRS 4410 to help guide compilation engagement. So due care around the accountant must act diligently, ensuring accuracy in compiling that information, and competency underscores the fact that the work must be done and reflect sound accounting knowledge, professional presentation, and skill by the practitioner. And compliance ensures following ethical codes of the profession, internal compliance, external compliance with professional standard. But there is no assurance level on the compiled information. Cannot make and check at the same time. So there's indirect comfort that comes from the accountant's professional conduct and ethical responsibility in compilation engagement. So we have direct comfort that comes from audit engagements, but for compilation is indirect comfort or assurance, use that word. So an example that emanates here or critically buttress this point is that a small business that is exempted from audit hires a firm to compile annual financial statements. This is an example of a compilation engagement from its record. So the firm follows ISRS 4410, prepares reliable financial statements, but it does not audit it or offer any audit opinion on that. And the essence of this standard is that it ensures professionalism even without assurance. So think about 4410 for work done right, not reviewed tight. You can use that mnemonic to remember. So that's it about ISRS 4410. Any questions? Any questions on this? All right, if we don't have, let's look at the next session. When an engagement letter is required for confirming, it's required for also an compilation engagement. So the purpose of the engagement letter is in carrying out compilation engagements ethically and professionally, even though there's no assurance provided, because you know that it's a compilation work, they need to clarify responsibility between the practitioner and the client. So an engagement letter must confirm that the work is not an audit. And that is the terms of reference. The engagement letter must have the input, and the content must state that it's not an audit work, it's not a review work, and it's just a compilation work. So the engagement cannot detect errors, fraud, or irregularities. It must be stated clearly in the engagement letter. And also the accuracy and completeness of the information rests with management, not with the compiler or the assurance, with the provider, the practitioner. Let me use the word practitioner. So the accuracy is like GIGO. What they give the accountant is what he used to produce financial statements. So I do a lot some consultancy jobs for NGOs and some startups. So they provide me with their information, invoices, receipts, and they ask me, please prepare financial statement. And what they give me, I use software mostly. I have proficient use of QuickBooks. So what I do is I take their data and post it on QuickBooks. It prepares financial statements for them, and I export the data. I'll use that data from QuickBooks to edit it and make it IFRS compliant, because most QuickBooks output are not IFRS compliant. And I send it back to the practitioner. So the accuracy of the information, it rests with them. They are the ones that gave me the information. I wasn't there when they were transacting or posting those transactions, collecting those receipts, buying, selling, having their assets. So what I do is I use my technical expertise as a chartered accountant to provide financial information for them and financial statements. So the accuracy and completeness of that information does not rest with the practitioner, it rests with management. So take note of that in compilation engagements. So the intended use and distribution of the compiled information is very important to be stated in the engagement letter. Also, the applicable framework to be used in compiling that information must also be stated. Whether it's IFRS or local GAAP, it must be stated. And the objective and scope of the engagement has to be enshrined in the engagement letter. Also, the practitioner's responsibilities, which includes ethical compliance, must be stated. Also, the expected form and content of the final report must be agreed by both parties. Also, the engagement letter must have planning and documentation for the practitioner to be guided. So he must properly plan, as is the same process with auditing. He must properly plan and document very essentially. So the practitioner must have adequate knowledge of the client's business and operations, the accounting system and record he uses, the financial reporting framework he uses, so that he can prepare in context and provide context to what the request is. Also, in the engagement letter is handling unsatisfactory information. The practitioner, if provided with incomplete data, inaccurate data, the practitioner should request corrections or improvements from management. So there are some data that are provided and you know this is not correct or this is not complete. You should request based on his expertise and his professional skill and judgment that this is what I'm supposed to get from you, not this. If management refuse to do that, that means they want him to pad information. Because of the ethical guidance and compliance, he may need to withdraw from the engagement like it is in an audit. When management provides data and say, this is what we did in revenue, and the receipts they give you or the invoices is not up to the amount. They say, no, there are some receipts that are missing. Just post that. No. The practitioner will tell you, I can't post invoices that I did not see you earn the revenue. Come on. My badge, my MB number of ICAN or whatever organization he uses at stake. I can't provide financial information that are not correct with evidence. So where his client is pushing him to do unethical jobs, he has to decline or withdraw from such engagement. And when management rectifies or amends the information, then he can go ahead. He also needs to notify the entity or his client of the withdrawal where handling unsatisfactory information for him to compile is not in line with professional best practices. Also, in the engagement letter, management responsibilities and the acknowledgement must be stated, just like it is in an audit. Management or those charged with governance must acknowledge responsibility for the final version of the compiled information, and it must be stated that this is what they gave us, this is what we gave the practitioner. The practitioner provided the information based on what he was given. So management is responsible for the output and the input. Very important. So summary on ISRS 4410 ensures that clarity, ethics, and responsibility is injected into the compilation work. So that his compilation work doesn't mean they just give a chartered accountant anything to prepare. There's no evidence, and they say this is what we have as creditors. No evidence, this is what we have as receivables. No. That you are not into audit work does not mean you should do shabby work. A chartered accountant, as long as you have that MB number, you are called a chartered accountant, you must provide service. Compilation engagement agreed upon procedures, audit-related service based on the highest standards of accountants, of a chartered accountant. That's why they call you a chartered accountant. So non-chartered accountants cannot give you information or clients and direct you because they are paying you. No, you are bigger than that. So it's very important to understand your responsibility on clarity, ethics, and responsibility in compilation work. So generally it's for the practitioner to provide the letter, which is the engagement letter, learn, understand the business processes, the client's business, what to do, what not to do. And where is necessary, he should leave the engagement where necessary, and also lock in responsibility. So those are the mnemonic and tips to understand from an engagement letter is required for compilation engagement. All right, so any questions? Running. Oh, okay. Thank you for the emoji. Thank you for the emoji. Appreciate that. All right, so let's look at reporting based on compilation engagements. Reporting. How do we report? How do the practitioner report? The purpose of reporting is to clearly communicate the nature and scope and his results of the compilation engagement, and also confirm there is no assurance provided. So in reporting, you need to think about only compilation, clarification, and communicating what you compiled. There's no assurance provided. So the reporting requirements must be in place. Each compilation report must be in writing or typed as we currently have digital tools these days. You have the title, which is the practitioner's compilation report, who it is addressed to, the addressee, which is management or those charged with governance, and the statement of work done. The practitioner confirms that he has compiled the financial information based on information provided by management. It needs to be stated clearly in the report, and that management is responsible for the accuracy and completeness of the information provided, because that's ego. What they gave him is what he provided out. So the applicable financial framework has to be stated also in the report, whether it's IFRS global or IFRS for SMEs or US GAAP or the local GAAP of that applicable jurisdiction, whatever it is, needs to be stated clearly. Also, identification of the financial information around the title, the owner of the report, the elements, what he used that guides the report and the work done, and also the date covered, speaking to the scope. What is the coverage? How many months, how many years, what period they see compiling the engagement or the report on. Also, his responsibilities need to be explained, that the engagement was conducted in accordance with ISRS 4410 revised, and the ethical standards of this standard was followed holistically. Also, the nature of the engagement needs to be described, and that it involves compilation expressly and explicitly, and not verification or review. Also, no assurance statement is provided in the report. He needs to emphasize that he does not verify data. He only expresses opinion or conclusion. He only prepared and compiled information reports provided to him. So key explanations in the compilation engagement report is that the engagement is not an audit or a review, very importantly, to state clearly. Also, the practitioner is not required to check the accuracy or completeness of the information supplied by management, but it has to be valid. Information has to be valid. They have to make sense. They won't give you rubbish to prepare, and you'll be like, this does not make sense. And you prepare it as a chartered accountant. Come on. So it has to be, it does not need to check for accuracy, but it has to ensure the information is valid and true to what it is preparing. The numbers have to tally. So where the compilation engagement is provided, there is no assurance, no opinion or conclusion is expressed, but then the information has to be true to what is given to provide an output. So an example of the practitioner's compilation report, in summary, he could have a statement of fact that says, we have compiled the accompanying financial statements of ABC company based on the information provided by management. This could be his statement. And he could continue by saying the engagement was performed in accordance with ISRS 4410 revised, which is addressing compilation engagements. And since there is no assurance engagement, we do not express an audit opinion based on what we've done or review conclusion. So this could be an example of a report that a practitioner could provide for a compilation engagement. He could sign it, date, and put his address or his MB number for us chartered accountants, if applicable, and sign it appropriately. So the insight around this is that ISRS 4410 ensures transparency, ethical clarity in non-assurance reporting. So these are audit-related services. So the report must tell, don't forget this tip, but it must not assure. Very important. So that's it about reporting on compilation engagements. And we're done with compilation engagements very practically. Any questions so that we can run to investigations? We have two more units, investigations and bankruptcy and liquidation. I think investigation and liquidation. Any questions so we can run? Any questions, observations, clarifications? Okay, if we don't, let's go quickly into investigations. Now, there are circumstances that warrant investigations, and accountants may be asked to investigate on behalf of others, and may be related, for example, to forensic audits, or may themselves be investigated by regulators or professional bodies. Like we know FRCN investigate audit firms. FRCN, the body that regulates, they are regulators in the financial reporting space in Nigeria. So these investigation activities are carried out by accountants, by chartered accountants also, to check chartered accountants. So it's very important to understand that investigations and circumstances could warrant investigation. So key circumstances where accountants are involved in investigations are areas of public inquiry, areas where investigation matters of national interest around factory accidents, diseases, outbreaks. Like during COVID, some chartered accountants were asked to carry out some risk assessment, carry out investigations on the outbreak, aside the health bodies that, aside the health bodies that were working actively to address the issue of COVID, there were also investigations by chartered accountants to look at risk areas, to publicly inquire on the issues around some of those pandemic challenges that time. So public inquiry could be circumstances that will warrant investigations. And the objective of this is to determine the cause and also recommend corrective actions. There's what we call CAPA. CAPA, we call it RCA and CAPA in auditing. RCA means root cause analysis. Auditors carry out root cause analysis. Chartered accountants do that. And to come up with CAPA, corrective actions and preventive actions. Corrective and preventive actions. So that's the objective of some of these investigations. And some of them are led by government-appointed independent chairpersons. So it could be judges, and some of the judges could involve chartered accountants. Since most of this information that to be investigated are financial information. Also, aside public inquiry, there's also failed audits. Yeah, auditors could fail and companies could crash. So failed audits could warrant investigations. Investigations around the Financial Reporting Council or the Financial Reporting Body coming to investigate audit was carried out. How come that bank crashed? Is it that the audit wasn't done well? The auditors didn't flag things. So failed audits could warrant investigations. And it occurs when an auditor's report wrongly stated that the financial statements were true and fair, or failed to identify going concern issues. So investigations could spring up. And this could be triggered usually that following corporate collapse. So there's a company case of BHS in the UK that crashed after one of the big four firms provided a clean report on that company. The FRC in the UK came after that audit firm heavily. In fact, they fined that big four firm. I saw the news and I read through the news. Very pathetic. In fact, the partner that signed the financial statement, he almost lost his license. He was fined, I think, £10,000 that time. It was a terrible collapse, corporate collapse. And some of these investigations are carried out by the FRC of UK that we have in Nigeria, the FRCN, or similar regulators that come to check issues around failed audits. And also the audit firm's internal quality control and external reviewer could also help mitigate some of these issues. And that is why the ISQM 2 has come up with external quality reviewer in the same firm that helps to check the opinion, check the findings, check whatever output the engagement team or the engagement partner is coming up with to avoid failed audits, so he can give an independent opinion. All right. The third circumstance that could warrant investigation are breach of ethical code, where professional misconduct or violation of ethical standards by accountants have come up. Like in ICAN, we have the disciplinary committee, which is equivalent to a court of appeal. If, for example, you are reported as a chartered accountant that you did something wrong in a bank, maybe you work as internal control or you work in the bank and financial reporting, and there were issues around fund issues with you, and something happened, you carted away with the money. And if the bank reports you to ICAN and ICAN finds you culpable, that's breach of professional conduct. ICAN can take it up and retrieve their certificate. They would court-martial you, they could even sanction you, penalize you, and at a point to rusticate you as a member. So those are forms of investigation. There was a case of a banker in Abia State, one of the big banks. I think he carted away with some money, and they invited him to DC. We call it DC, Disciplinary Committee. I think it was last year. late last year. And the guy didn't show up. And I can put it on their journal, put it on the list that he's no longer a member, posted his picture everywhere that nobody should transact business with him. Because he didn't even show up. And the bank meted out a lot of allegations against him that this is what he did. He carted away with some money. And that's how ICAN carries out such investigations and provide very serious reprimands and mete out a lot of terrible justice. Like if you correct the certificate, I read the certificate when I say, so is this certificate that suffered me for how many years? I read it and they said, this certificate is the property of ICAN. I say, oh, so after all this wahala self, it's not even my own. The property is the property of the Institute of Chartered Accountants of Nigeria. So they have the right to retrieve it if anything goes wrong. They'll ask you to return their certificate to them. Say, okay, so after all the induction money I've paid, subscription, you will still tell me this is not my certificate. I say, it's all right. All right, so breach of ethical codes and conduct could make bodies like ICAN and other oversight authorities investigate professionals. Also, suspected money laundering issues, issues involving illegal financial activities, terrorist financing, concealment of funds could warrant investigations, and chartered accountants are mostly at the front line carrying out some of these investigations. Also, they could be investigated by the police, specialized agencies, EFCC. You see that EFCC has a lot of chartered accountants as auditors, as fraud experts, and all that. Also, bankruptcy and insolvency investigations, which focuses on insolvent companies or individuals to trace causes and recover assets, are also conducted by official receivers, government agencies. Mostly, you see that they are chartered accountants in this sphere or this space to help dig out financial misconduct where suspected. Also, investigations around government spending reviews, examining value for money audits, whether public money is used effectively and efficiently, are areas where maybe the National Audit Office in Nigeria, you have the EFCC, the ICPC, government auditors carrying out investigations. Also, we have value for money audit investigations also. These are areas that could warrant investigations in assessing the economy, efficiency, and effectiveness in resource use. So most of these investigations are performed by internal auditors. We'll look at that when we come to chapter 13. So the key takeaway for this investigation is that it can be reactive after a failure, after a risk has crystallized, fraud risk has crystallized, complaints, and it could be proactive to assess efficiency or compliance. So investigative are two-way, reactive or proactive. So those are the circumstances that could warrant investigations to be carried out. Any questions? Any contributions, observations? All right, if there's none, let's run. Let's look at the second section on investigations and the International Audit and Assurance Standard Board and how this aligns. So there are no formal definition of investigations based on international standards on auditing. We don't have any standards guiding investigations, and investigations are not required to follow ISAs like statutory audits. But applicable rules depends on the type of investigation and legal authorities under which it falls. So the IASB references to investigations, although are not defined in the handbook IASB provided, but it mentions investigations in certain contexts in that handbook and mainly relating to audit quality around misconducts and regulatory reviews. So type of investigations recognized by the International Audit and Assurance Standard Board context speaks to audit failure investigations. And this is conducted by professional accounting bodies or independent regulators like FRCN. And the aim is to examine why an audit failed and was improperly performed. So some of these bodies like FRCN in Nigeria, FRC UK, Public Complaint Oversight Board in US, those ones are terrible. If there's failure of audits, they could go as far as even jailing the auditor. Their own is horrible in the US Public Complaint Oversight Board. In fact, those people, if they write an audit firm that they are coming after them, most audit partners used to flee the country. Their laws and penalties are very stringent in that jurisdiction. So the aim is to check why audits failed, and if the auditors are culpable, then they will be liable also. Number two is internal investigations are also mentioned in the IASB handbook around investigation by audit firms. And these arise when firms look into complaints or allegations of wrongdoings, deficiencies in design or operation of quality management or quality control processes for audit firms, non-compliance by individuals, I beg your pardon, with the firm's policies in carrying out audits. Areas of exceptions or inconsistencies detected during audits could warrant investigations by audit firms. Peer reviews. An audit firm could be asked to check an audit firm also. We also have regulatory or government investigations mentioned in the IASB handbook on investigations, which is conducted by regulatory organizations like FRCN or government departments, EFCC, ICPC. And this may lead to, if found wanting, fines, penalties, or sanctions if non-compliance or misconduct is found. Also, you have investigations of illegal acts, which are initiated by appropriate authorities into actual suspected illegal acts within an entity or profession. So, for the IASB investigation context or the guide on investigations, reasons that could trigger investigations speaks to audit failures, number one, internal misconduct or allegations on audit firms, regulatory or government reviews, misconduct around policy or quality management breaches, legal or illegal acts like money laundering and theft, corruption charges, and all that could warrant investigation. So this acronym FEML could help you remember reasons why investigations may be carried out and what is the IASB's context or guide on investigations. Very important. All right, any questions? Okay, let's run. The next unit we'll be looking at, or the next session we'll be looking at comparison of statutory audit and investigations. What are the key differences? So both statutory audit and investigations involve examination of financial information. Their objective, their scope, and responsibility may differ significantly. So we have the duties and responsibilities in looking at the difference between statutory audit and investigation. In statutory audit, the auditor's duty is to express an independent opinion on whether the financial statements give a true and fair view in accordance with the applicable financial reporting framework. But the investigator's responsibility under investigation or special investigations by the appointing body or the terms of reference of the engagement letter is meted out. So this is not streamlined, but the statutory audit is streamlined in terms of duties and responsibilities. So in some cases, these duties may also be established by law, speaking to investigations, depending on the nature of the investigation. Depends on so the establishment of the duties or the responsibilities depends on the investigation and could be provided by law or regulation. And the objective of statutory audit speaks to providing reasonable assurance that financial statements are free from material misstatements, whether due to fraud or error. While investigation, the objective is to establish facts and gather evidence related to a specific matter or concern, such as suspected fraud, misconduct, financial loss, or regulatory breach, and report the findings very objectively without bias. Number three is the scope. We're looking at the difference now between statutory audit and investigation. The scope of statutory audit is broader and covering the entire set of financial statements and the internal controls relevant to that same financial reporting. But investigations could be narrow and specific to a particular issue. It's limited to examining areas of fraud, financial irregularity, or a performance concern. And another difference significantly is reporting. Statutory audit report and the results are provided or presented in a standardized audit opinion format around unmodified opinions, qualified opinions, adverse opinion, or disclaimer of opinion. So unmodified opinion could be unqualified opinions. They are the same synonyms. And it could be addressed to shareholders or owners of companies or those charged with governance. But the result of investigation is a special report presenting facts, evidence, conclusions, and forensics, if possible, forensic evidence, and recommendations is addressed to the appointing authority, such as maybe management regulators, the court, based on what the investigation was provided for. We also have another difference in frequency and duration. Statutory audits are conducted annually and form parts of an entity's regular reporting and verification and review cycle. But investigation could be ad hoc. It doesn't have statutory provisions. It will come up as the need arises, such as allegations, disputes, irregularities, and checks based on whistleblowings, a lot of things. Also, another area of difference between statutory audits and investigations are the use of resources. Statutory audits are used by investors, regulators, and stakeholders for decision-making and assurance purposes, while investigations are used for disciplinary actions, for litigation and court purposes, policy decisions, and corrective measures within an organization. Those are the use of the results of investigation. So those are the brief points we could speak to around statutory audit and investigations comparison. All right. Okay. I think this slide was duplicated. Okay. I think there was a duplicate. Pardon me. Okay, so let's go to the next section on stages of an investigation. Stages of an investigation. Number one, there has to be acceptance by the practitioner. He has to accept the investigation that has been provided to him. And he must have, number one, and consider the competence and expertise in that area. So, for example, most forensic investigators are also lawyers because they have to understand court proceedings and how to present evidence in court. So where a chartered accountant doesn't have law expertise, he may need to decline or consider taking investigation engagements. He also needs to consider his staff and the time to complete the work, the staff and the duration to complete the work. He also needs to consider compliance with ethical standards. So before accepting the work, these are key considerations he needs to take and bring to bear. Also, investigation procedures depend on the subject matter on what they are investigating, and it may involve inspection, interviews, document reviews, or analysis of evidence. Also, reporting on investigations are case-specific and may include the addressee, the client that is receiving the output, and responsibility statements based on the responsibility of the client and the practitioner, the scope and procedures performed in the investigation, and his findings, his conclusions, recommendations, and the limitation of scope. So we have investigations that are currently on, and by law, the Financial Reporting Council has carried out or provided issues around assurance of internal control over financial reporting. This is different from audits. In my last business, my last place of employment is a public interest entity that is required to carry out assurance on internal control over financial reporting. It's called ICFR. So this is a current issue. So please take note of it. It may show up in your AAA paper. ICFR is a current issue. So take note of it, please. ICFR was asked or came up as a result of ensuring that the process of financial reporting production is seamless and is in line with COSO framework. That was the essence of FRC coming up with assurance of internal control over financial reporting. And management, speaking to the CEO and the CFO, is responsible for that. Management is responsible for internal controls and ensuring the production of financial statements is okay. That's why assurance has to be provided by them. So most companies that started this engagement used independent audit firms to start the engagement. Then later they carry it out by their internal control or internal audit department. And the objective of the assurance on internal control over financial reporting is to provide assurance on management's assessment of internal controls over financial reporting. They want to provide assurance on management's job of ensuring that the output, which is financial statements, and the internal controls are viable and they are strong in producing those financial statements. So for this assurance engagement, the practitioner responsibility of the chartered accountant is to maintain independence, skepticism, and due care. He also needs to plan, supervise, and document the engagement on ICFR. He also needs to obtain sufficient evidence via inspection, inquiry, performing tests, and confirmations. Then very importantly, he needs to follow the COSO framework on internal controls. COSO framework, take note of that. The COSO framework has 5 elements. The control environment, don't forget, risk assessment, control activities, communication and information, then monitoring. Those 5 elements must be resident in a sound internal control system. And the engagement requirement speaks to the signed engagement letter with management, obtaining management's written assessment of ICFR, and also apply the same materiality used in financial statement audits for also the ICFR engagements. So those are the ICFR engagements. So please take note of these key requirements. It's a 2014 injection by FRCN, and it's a likely examinable area. So take note of it, please. Also, the top-down approach, talking about risk-based approach in carrying out ICFR on the entity level and significant account controls is the approach that is used. So control testing and deficiencies around assessing the design and operational effectiveness of the internal controls is the job or the task that is the practitioner is faced with. Also, identifying material weakness such as management fraud, restatement of prior period financials, significant misstatements or poor oversights are areas of review in the ICFR. Also, he needs to come up with a conclusion around qualifying the opinion or a disclaimer speaking to scope limitation, or a qualified or adverse opinion speaking to material misstatement, or withdraw if the scope is severely limited and he cannot cover where you provide comfort or assurance on the ICFR. He also needs to obtain written representations where management must confirm responsibility for the ICFR. So the ICFR is internal controller of financial reporting. Principally, the CEO and the CFO are responsible for these controls. You need to disclose fraud, deficiencies, and post-year changes. And internal auditors are instrumental, internal control people, their departments in the organization are instrumental to facilitating this. Also, areas around failure to provide representations could culminate in scope limitation by the auditor. So the ICFR engagers or providers need to communicate to those charged with governance. All material weakness must be reported in writing before issuing the final report. Like I remember that time when the ICFR started, they asked the internal audits to provide them with a lot of documents, policies, risk registers, risk reports, risk policy, and all that. And they were using it to check the internal controls before they finalized their reports. So it was effective, like I said, December 2024, the FRC management's guidance on ICFR. Take note of it. And the applicability is to all public interest entities, especially small companies. Sorry, except small companies are exempted. Microfinance bank exempted, insurance brokers exempted, and non-tertiary institutions exempted. But public interest companies, PLCs, is mandatory for them to have ICFR. So for ICFR, management responsibilities are enshrined clearly and is to maintain and evaluate internal control effectiveness, certify controls, and these 2 principal officers are responsible. The CEO, like I said earlier, and the CFO must sign and certify these controls within 90 days before report date. Take note of that. Also disclose, management needs to disclose significant deficiencies, fraud, and post-year end changes in that report, and also provide documented evidence to support risk assessments and any assessments they have provided. So the framework that is guided or that guides ICFR is the COSO framework, like I mentioned, the COSO framework, and the assessment to appear before the auditor's report in the financial statements is very clear for ICFR. So those are stages of an investigation. I would really recommend you take note of the ICFR. It's a new injection. Take note of it, please. Okay, so any questions? We just rounded off investigations, and ICFR is a key feature in that unit. Any questions? I hope we're not sleeping or everybody is quiet. I know Sammy is not sleeping, sure.
Not at all, sir.
I'm just wondering.
So you think it is sleeping? Only Sammy.
A lot of
You
us
can
are
only
worked
vouch
out.
for only Sammy, right?
Yes, so I know Sammy is always gingering me now. So it's nice to hear you,
Okay.
Jay.
I'm
I'm
here,
glad you're
Malgao.
not. Oh, fantastic! I can see. I can see Mike is here.
Yeah.
Good. So I have a lot of people with me. So
Okay.
it's nice to have you.
Okay.
So ICFR, I was speaking to ICFR. I was saying that you guys should take note of that key area so that if it shows up, okay. Thank you, Afolabi. I'm seeing your emoji. Thank you, Baz Global. Thank you. I'm not alone, so it's good to have this feedback and confirmation. So please take note of that ICFR and read it. I'm having some feeling that it may show up in your exams, so please take note of it. All right, so let's look at this last. Okay, please go ahead. You want to say something? Go ahead.
No, I said noted, sir.
Okay. All right. Thank you for that feedback. Please, it's 10 o'clock, I know, but please, let's conclude. This is the last unit. Let's conclude on this. So we don't come back tomorrow and be talking about lectures. Tomorrow we're looking at past papers. So please, let's conclude on liquidation and bankruptcy. I'll run through it. We are aware of this, but I'll just run and then we would conclude for the night. Okay, so the idea around liquidation and bankruptcy means the winding up of a company. That's the process of bringing a company's affairs to an end. That speaks to winding up. Then for liquidation, it speaks to the company assets are sold and realized, and the proceeds used to pay creditors, those the company owe, and any balances is distributed to shareholders. So that's the idea around liquidation. Then for dissolution, speaks to the final stage where the company's name is removed from the register. That's the CAC, and it's legally ceased to exist as a corporate person. That's the idea around dissolution. Then insolvency speaks to when a company cannot pay its debt as they fall due, whether short-term, long-term, and its liabilities exceed its asset. Then the company is insolvent. And solvency talks about when a company can pay all its creditors in full from the sale of its assets. The company is still solvent. So generally, these are the general ideas around winding up, liquidation, dissolution, insolvency, and solvency. So it speaks to the end cycle of a company, speaking to winding up, liquidation, distribution of assets, insolvency, checking it, and striking up the company's name out of the CAC or the register. So for example, if XYZ Limited can't meet its loan repayments, significant loan repayments either to a bank, a liquidator sells his assets, pay the creditors, we could include banks and suppliers, and also distribute any leftovers to the ordinary shareholders if there is. And once complete, XYZ Limited is dissolved and ceases to exist. So that is an example of a scenario of bankruptcy and liquidation. All right, so that's a general introduction. Let's look at insolvency versus illiquidity. Now, insolvency, like we said earlier, is a company's total liabilities is higher in amount than its total assets. So the net liabilities, we have a positive figure than the total assets. And it indicates a long-term financial problem. So it's practically speaking to the business not being viable. That's what insolvency means. But illiquidity means the company cannot meet its obligations in the short term. But in the long term or in the long run, they are looking okay. The assets are above their liabilities in the long run. But then you need short term, and that's why liquidity is very important. If you cannot run in the short run, then your future will be truncated. So a company that cannot meet its short-term obligations will soon be out of existence or will soon struggle to run the business. And illiquidity is very dangerous as much as insolvency. So this illiquidity is often caused by poor cash flow, even when asset exceeds liabilities. It's doing well in the long run, but in the short run, it can't just have money to run, cash to run. And that's why liquidity is very important. One of the key risk indicators I performed in my former office is CA over CL. That's current ratio. That parameter is very important for every company to perform and to check that key risk indicator every quarter. You must ensure that your current assets are above your current liabilities to avoid illiquidity. You start flagging issues of illiquidity when you see your current asset is either 1:1 or 0.5:1 of the current liability, then you start flagging it that there's problem. So illiquidity must be avoided by companies at all costs. And the key difference is that insolvency is the balance sheet issue, having your the company's liabilities above the assets, while illiquidity is not an insolvency issue or a net liability issue. You're having a cash flow issue. Speaking to timing of payments, monthly payments, quarterly payments, or yearly payments, to be able to meet those obligations are very pertinent for companies to succeed and be liquid. So, for example, a company owning valuable property could be solvent and may still fail to pay suppliers on time, maybe monthly suppliers, and that could speak to illiquidity. But you have property that is above your liabilities, but then you don't have cash to pay suppliers that give you raw materials to provide the goods and services you provided. It's an example. So take note that the winding up process differs depending on whether the company is solvent or insolvent. So take note of that. And that's the difference between insolvency and illiquidity, very practically. So let's look at insolvency. If we don't have any questions, if you do, please bring it on. Don't mind that I'm running. Bring up any questions if you have, please. All right, let's look at insolvency in context. Insolvency in context. Now, the main causes of insolvency, number one, is overtrading. Speaking to rapid business growth without sufficient working capital. So you are trading, you are building up long-term assets, but your short-term cash flow is not being built up. That means sufficient working capital is necessary to fund operations or pay day-to-day obligations around short-term liability. So overtrading could be the cause of insolvency. Number two is long-term unprofitability. Speaking to continuous losses, eroding capital, and weakening the financial stability of the business. The long-term unprofitability could cause insolvency. And the result is that the company becomes unable to meet debts as they fall due, leading to insolvency and potential liquidation. So that's insolvency in context around the reasons for it and what could trigger a company to go out of business. All right, let's look at the next session on bankruptcy, winding up, receivership, and administration. So when a company faces liquidity or insolvency issues, there are two main options. Number one is to wind up, to close out or close down the company. Speaking to assets are being sold to repay creditors, and if there's balance, they give it to shareholders. If there's none, the shareholders go home with nothing. And the second one, if there's chance of survival, speaking to areas, the idea of rescue attempts, an insolvency practitioner may be appointed to manage and attempt to restore profitability to the company or to the organization. So this period is called the period of administration, where an insolvency practitioner will take over the company and see how to run it profitably. And that's the idea around bankruptcy, winding up, receivership, and administration. Also, the next session could be where they will ask auditors for help to avoid insolvency, asking auditors for help. So bankruptcy is a legal declaration that a company cannot pay its debts. It's a legal declaration. You're coming out to say, hey, I'm drowning, I cannot pay my debts. That's the idea of bankruptcy. And this Bankruptcy Act is governed in Nigeria by the Bankruptcy and Insolvency Act, which was repealed and reenacted in 2016. It's a bill that was passed. And usually it follows insolvency. And the idea of winding up can be voluntary. The company could voluntarily wind up, and it could be compulsory by the court. Maybe creditors take the company or takes the company to court, and the court has looked at the books and decided that the company should shut down and pay these creditors. They cannot continue. So winding up could be voluntary or involuntary. And a liquidator could be employed to sell the assets and pay the creditors that are petitioning the company every time, and also distribute, if available, the surplus to shareholders. We also have the idea of receivership, which is an appointment by a creditor or a court to realize the secured assets and repay the secured debts. So we have secured debts and we have unsecured debts. So where you have covenants with debtors to say, okay, if I cannot pay you, this part of my assets should be sold to retrieve your money. such areas where companies actually cannot pay, a receiver is appointed to carry out that covenant and that contract. And the receivership acts in the interest of the creditor, not in the company's interest. He's securing the creditor's money back. So after debt repayments, control returns to directors or liquidator because he has a claim on the assets. And the receiver is also administering the debt obligation and is aimed at maybe rescuing companies in financial distress. That could be the objective of the liquidator at that point. Also, there's allowed time to restructure and trade out of difficulties if the liquidator is appointed to bring his expertise and see how to provide a shift for the company to profitability. And the objective around liquidation, what the liquidator is taking over the company, is to repay creditors and try to see how to keep the business running. So most liquidators are auditors, so they could be asked to help to move the company forward or take the drowning company and see how they could stay afloat in perpetuity. All right, so that's it for the chapter on liquidation and bankruptcy. And ladies and gentlemen, by this time you should be able to describe the conduct of review of engagements in accordance with ISRE 2400 and 2410. And also you should be able to describe those of related services compilation around ISRS 440 on AUP and 4410 on compilation engagements. And also be able to discuss investigation and where is necessary and the stages involved. And also explain the basic principles of company liquidation, bankruptcy, winding up, insolvency, and those concepts. All right, I think I used 12 minutes to speak to that. So we'll stop here